This market was started in 1920s by the British as an informal market for Europeans only.
We began in a different time. A time when a clean cut and a sharp suit got you ahead.
In 1954, the market was formalized through incorporation into a company. In 1963, Africans were allowed to join and trade in the market. For many years, the market operated through a telephone with a weekly meeting at Stanley Hotel. In 1991, this market moved to IPS building and was opened to the public. In 1994, the introduction of Central Depository and Settlement Corporation (CDSC) enabled investors to open shares and bond accounts in electronic accounts similar to their bank accounts. Buying and selling of shares and bonds was made much easier and quicker. So what is this market all about? The Nairobi Securities Exchange, NSE as it is known, is a dealer market that provides an organized trading platform for the buying and selling of financial instruments of publicly listed companies. Currently listed on NSE are 64 stocks from companies across 11 sectors of the Kenyan economy. Some of them are banking, investment services, agriculture, among others. The products traded at the NSE are shares, also known as equities, and bonds, also known as debt instruments. Shares and bonds are money or financial products. In simple terms, the market brings together the users of capital, also known as borrowers, and suppliers of capital, also known as lenders of capital, enabling productive use of idle money or savings to grow the economy. A share is simply defined as a security that represents the ownership of a fraction of a corporation. On the other hand, a bond is a fixed income instrument that represents a loan made by an investor to a borrower, who could be a government or a company, where you get paid an interest on periodic basis and your money back on maturity. Currently, the bonds in the market have an interest that ranges from 8% to 14%, depending on the type of bond and when it was issued. Through shares and bonds, the government, small and big companies, cooperative societies, and other organizations can raise money to expand their business activities, make a profit, create employment, and generally help the economy to grow. So apart from the above products, shares and bonds, there are other products that were recently introduced in the market for trading to help companies raise capital. So one of them is a REIT. A REIT is a real estate investment trust. And another one is what is referred to as ETF, an exchange traded fund. So what is a REIT? A REIT is a regulated investment vehicle that enables the issuer to pool investors' funds for the purpose of investing in real estate. In exchange, the investors receive units in the trust, and as beneficiaries of the trust, share in the profits or income from the real estate asset owned by the trust. There are two types of REITs that are trading in the market right now. One of them is referred to as D-REITs, and the other one is I-REITs. I-REIT stands for income rate. It is simply a real estate investment scheme which owns and manages income-generating real estate for the benefit of its investors, therefore providing both liquidity and a stable income stream. This means that income returns are generally predictable. On the other hand, D-REIT stands for Development Real Estate Investment Trust, which is a development and construction real estate trust involved in development or construction projects for housing, commercial, and other real estate assets. On the other hand, An exchange-traded fund, ETF, which was introduced in 2015, is a listed investment product that tracks the performance of a basket of shares, also known as index. An ETF can also track a single commodity such as oil or a precious metal like gold. NSE has what we call NSE 20 or 25 share index traded just like stocks in the market. The market is open Monday to Friday from 8 a.m. to 5 p.m. Trading activities start at 9 a.m. and continue until 3 p.m. Members of the public can view the market from the public gallery at any time while the market is open. The market is closed during public holidays. Shares are displayed into 4 sectors, namely agriculture, commercial and services, financial, industrial, and allied sectors. The shares are displayed in alphabetical order in each group for easy location by investors viewing trading from the public gallery. On the other hand, bonds are grouped into 2: treasury bonds issued by the government and corporate bonds issued by companies. They are displayed as and when the government or a company issues one. There are 2 kinds of investors who participate in the stock market. One is an individual, and another one is an institutional investor. Individuals are people like you and me who buy in thousands, not so large quantities, while institutional investors are the ones who buy in millions and billions. They buy in large quantities. When buying shares in the stock market, they are bundled in minimum lots of 100 shares and above in the market boards. Fewer shares that are less than 100 are available in odd lots board. Bonds are sold in minimum bundles of Kenya shillings 50,000. Small investors can pull their money together and buy a bond with the help of a money manager. So there are benefits of engaging in the stock market. One of them is it is a source of profit. Another one is a way of saving your money for future. It is also an easy way and a quick asset to buy and sell. Buying at low prices and selling at high prices will help you make profits.
Investing has now gone digital with the Nairobi Securities Exchange application. To get the app, go to your Play Store or App Store, download and install the Nairobi Securities Exchange app. Here you will get market statistics, personalized notifications, financial news, and much more. Start your investment journey and keep getting regular updates on the app. The Nairobi Securities Exchange app. Investing goes digital.
All you need to start trading in the stock market is some money and of course decide which stock you want to buy. The trading mechanism in NSE was automated in the late 2000s and has enabled ease trading since then, and more trades can be executed per minute. You can buy through a stock broker or an online broker or an investment manager or financial advisor. For one to trade securities in NSE, one needs to open a CDS, or what is referred to as Central Depository System account. It's like a bank account where you put your money there and then advise your stockbroker to buy on your behalf. It is simply a trading account. The account is unique to each investor and can be opened on an individual or joint basis. This account, managed by the Central Depository and Settlement Corporation or CDSC, acts as a bank account for the stock and security market and the body. CDSC ensures all settlements have been paid out. Opening a CDS account can be made at the central bank or at the local Central Depository agent, and will need filling a CDS-1 form and submission of a few personal documents. This includes 2 passport size photograph, a KRA PIN, a national ID or passport, evidence of residence, and evidence of income. However, if one fills a CDS form at a bank in which one is a member, One will only need a passport-size photo and an original copy of national ID. Once you deposit funds in your CDS account, you can advise your stockbroker to buy on your behalf, or you can simply go online, log into your account and take a market position, which means you decide to either buy or sell a stock. If it is your first time, of course, it will be buying. When buying shares in the stock market, long-term approach is advocated. The market is volatile because of market forces. The performance of specific company and various economic conditions affect how shares perform in the short term. Investing in stocks does not guarantee returns or profit. It is a risky affair, especially if you do not know what you're doing. There are two approaches you can use to buy shares that have been used in the history of the stock market. One is a technical approach and the other one is fundamental analysis. So what does fundamental analysis mean? It means involving analyzing factors that could influence stocks' future price based on the company management, financial health, market share, and many other factors. Those who use this approach believe that some stocks are mispriced or undervalued in reference to their company performance, and you should buy them low and sell them high. On the other hand, technical analysis involves analyzing the stock's price movement through charts, patterns, and graphs in anticipation of price movement. This analysis method can be believed to be advantageous in the short term for profit. It is advisable to buy when prices are going down rather than when they are going up. As Buffett suggests, be greedy when others are fearful, and vice versa. So when investing in the stock market, make sure you invest in a company whose business model and industry you understand to remain updated and informed about the share performance. Again, make sure you evaluate the financial health of the company, check whether they have debts, check whether they have the ability to pay those debts. So your approach or your strategy should be very simple. If you cannot explain it to someone who have never invested in a stock market, then I deem your strategy is risky. Make it simple, keep it simple, and learn from those who have succeeded in the past.
There's something I normally say: every shilling of investment that I send out there, it comes back loaded with lessons. Every shilling, and it has never ceased, because some you make a lot of money, obscene money, and some you lose quite a bit of money, and you just hope that you make the whole portfolio makes more money than it loses. But even today, I still can't tell you this is guaranteed. In fact, that's a word we are not allowed to use, because investment is about the future. Yeah. So when you start early, you have so much headroom to pick as many lessons as possible. I can only imagine 15 years from now, he's going to be better than me.
Once you start trading, make sure you understand the rules of the game. Learn as much as you can. Understand the game. Do not engage in something that you don't understand. It is very risky to learn how to fly a plane when you're up there. So learn as much as you can from those who have succeeded in history. Be patient, keep investing. In the long term, of course, you're going to have some losses, but on average in the long term, if you do it well, the wins will be more than losses. Wish you all the best.